If I had to start building an AI watch list today from scratch, knowing what I know about how this money is actually moving, what's getting crowded, what's still being missed, and what kind of businesses can quietly ride this wave for years, I would do it very differently. Most people still think the AI trade is only about buying the loudest chip stock, chasing the flashiest headline, or jumping into whatever ticker is flying that week. But that's not really what this is about anymore. We're not just looking at a software story or a hype story. We're watching a rebuild of the physical world that sits underneath AI, and that changes everything. It's Monday, April 20th in New York, and before we go any further, comment the day and date you're watching from. And if you value this kind of breakdown, subscribe and comment John A.G. Best so I know you want more of these. Now, here's the thing. A lot of people saw AI names rip higher again and assumed this was just another sugar rush, another squeeze, another little market mood swing. And sure, some of that is always in the mix. Markets love to overshoot, traders love to dogpile. Short covering can make a stock look like it was launched out of a cannon. But that's not the full story here, not even close. Because underneath the fireworks, there are real estimate changes, real orders, real bottlenecks, real power needs, real cooling needs, and real infrastructure spending that still hasn't finished working its way through the system. That's why I want to walk through 5 names and 5 corners of this trade. Not in the usual lazy way where people just yell AI and point at a chart, but in the way that actually matters. Where's the money going? What part of the machine is getting fed first? Which companies benefit if the build-out keeps rolling? And just as important, where do I think people could still get hurt, even if the long-term theme stays alive? Because that's the part too many people skip. They think if the theme is real, every stock tied to it must be safe. No, absolutely not. A real boom can still create terrible entries, shaky balance sheets, messy execution, and stocks that act like drama queens for months at a time. So yes, I'm bullish on the broad AI infrastructure runway. I'm also telling you right now that some names in this space can still punch you in the face if you chase them at the wrong time. So why did these stocks come roaring back so fast? I think there are a few layers to it. First, earnings expectations started improving again. And when the street begins lifting numbers into a market that had been nervous, underweight, or a little too cute on timing, money moves fast. Second, the latest read-throughs from the supply chain were not weak. They were strong. Based on recently published numbers, one of the biggest advanced chip manufacturers in the world just put up revenue growth around 40% in dollar terms and profit growth close to 60%, while also signaling AI demand stayed extremely robust. And spending plans were leaning higher, not lower. That is not what a dead theme looks like. Third, this rally is broadening under the surface. Not everywhere, not evenly, but enough to matter. From recent market updates, strategists are starting to talk about AI demand spreading beyond just the obvious graphics chip winners into memory, general processing, storage, networking, power, and all the stuff nobody brags about at cocktail parties. That matters because once a trade stops being a one-stock religion and starts becoming an ecosystem build, the opportunity set gets much bigger. And fourth, a lot of the earlier selling probably had more to do with market mechanics than with some grand collapse in the business case. Good stocks get overbought, then they get smacked, then people panic and act like the story changed overnight. Meanwhile, the backlog is still there, the customers are still spending, and the next quarter still has to be delivered. I'm not saying every drawdown is fake. I'm saying sometimes the tape gets dramatic long before the business does. Now let's talk about where the money appears to be flowing. The first bucket is the electrical spine of the data center. Not the glamorous part, the absolutely necessary part. Cabinets, protection, connections, control equipment, and the kinds of systems that make high-density compute actually function without turning into a very expensive space heater. This is why a name like nVent gets interesting. It sits in that less sexy zone where investors sometimes look away because the company does not scream futuristic. But that's exactly why the setup can be better. When a boom gets physical, boring suppliers start acting a whole lot less boring. And the reason I like that corner of the trade is simple. Every new build needs the guts. Every upgrade needs the guts. Every shift toward denser racks, more power, more heat, and more liquid cooling puts pressure on the supporting hardware around the servers. You can dream all day about trillion-dollar software outcomes, but if the room cannot be wired, protected, and cooled correctly, the dream stops right there. There's also a duration argument here. This doesn't look like a one-quarter fling. A lot of these infrastructure suppliers are still talking, like demand visibility stretches well beyond the next earnings report. Not forever, obviously. I'm always careful with words like forever, but long enough that this still feels more like a build cycle than a quick trade. Now the second bucket is power, and this one is huge, maybe bigger than most people realize. Because AI has a dirty little secret. It doesn't just need smarter chips, it needs absurd amounts of electricity. Recent energy forecasts show U.S. power demand likely pushing to fresh records this year and next, and a lot of that conversation now runs straight through data centers. That doesn't mean every extra kilowatt comes from AI, but it does tell you the grid story is getting tighter right when compute demand is getting hungrier. And when the grid gets tight, on-site and near-site generation suddenly becomes very attractive. That is where Bloom Energy enters the chat. You don't have to love every green narrative on Earth to see the appeal here. If a customer needs faster deployment, steadier supply, and a way around waiting forever for traditional grid upgrades, fuel cell systems start looking very practical. And this is not just theory floating around on social media. According to the latest publicly available announcements, Bloom expanded its arrangement with Oracle to support close to 3 gigawatts of fuel cell capacity, with well over a gigawatt already moving into deployment across U.S. projects. That is serious scale. That is not somebody testing a cute pilot program in the parking lot. Now, does that mean Bloom can't get ahead of itself? Of course not. A stock can outrun the business for stretches. A name can get crowded. Traders can turn a legitimate story into a circus. That's always possible. But if you're asking whether the demand side looks made up, no, it doesn't. It looks like the market is finally catching up to the idea that the AI boom is also a power procurement boom. Third bucket, cooling. And honestly, this may be the simplest part of the whole thesis to understand. More compute means more heat. More heat means more spending on thermal management. End of story. If racks get denser and workloads get nastier, cooling goes from background detail to mission-critical budget item. That is why comfort systems keeps showing up in these conversations. It's not a pure-play AI darling. It's a practical operator sitting right where physical demand is rising. This is where smart investors separate story from ego. Some people only want to buy companies that sound futuristic. They want the ticker they can brag about. They don't want the contractor. They don't want the cooling name. They don't want the company that helps keep the box from melting down. But markets do not pay you for sounding impressive. Markets pay you when you own what the spending wave actually needs. And if the build-out stays strong, cooling budgets do not magically disappear. They probably rise. Now the fourth bucket is memory and storage. And this is where people need to pay attention because the AI conversation is evolving. It's no longer just who has the best accelerator. It's becoming who can feed the system, who can store the data, who can move it, who can keep the model supplied without bottlenecking the entire machine. That's why I think a name like Seagate deserves a serious look. A lot of people instinctively jump to flashier memory stories, and I get it. Some of those charts have been insane. But the broader point is that memory is moving from support role to strategic asset. Based on recent company commentary across the space, tight supply and AI server demand are still shaping the market. And some forecasts tied to high bandwidth memory have ballooned into the $100 billion neighborhood over the next few years. When numbers start expanding like that, you don't just look at one winner, you look at the whole chain. Seagate is interesting to me because it sits in that quieter part of the story where mass capacity storage still matters, enterprise demand still matters, and the market may not always price the importance correctly until later. Could another name outperform it? Sure, I'm not marrying the ticker. But I do understand the logic of preferring companies where improving demand meets a cleaner fundamental profile instead of just blindly chasing whatever went vertical first. And that takes us to the fifth name, the one everyone wants to argue about, Supermicro. Now, let me say this very carefully. You do not have to love this stock to understand why people keep coming back to it, and you definitely do not have to trust it blindly. In fact, I would argue the blind trust approach is exactly how people get burned in names like this. The bull case is obvious enough. The company sits in an important part of the server and rack stack. It has exposure to liquid-cooled systems. It has ridden the AI build-out hard, and recent company reporting showed a huge jump in quarterly sales, while management talked about a rapidly expanding order book and a much higher annual revenue target. So the operating story is not fictional. But here's the counterpoint, and it matters. Backlog is not the same thing as clean execution. Sales growth is not the same thing as trust. A cheap multiple is not a magic shield if the market still doubts governance, margins, reporting quality, or the durability of the demand pulse. That's why I think this one deserves a more skeptical frame than the cheerleaders give it. Yes, it can work. Yes, it can keep squeezing people who hate it. Yes, it can look statistically inexpensive compared with the growth story. But it also has baggage, and baggage changes how a stock trades. So for me, Supermicro is not the symbol of the whole AI boom. It's a test of how much mess investors are willing to tolerate when the top line is exploding. Some people can handle that, some can't. And honestly, a lot of retail investors who got torched before are going to need more than one strong quarter before they emotionally forgive this name. That's just reality. Still, I also think it's a mistake to dismiss it as untouchable. One reason is that key customers clearly still need advanced server capacity. Another is that the broader infrastructure cycle is not finished. And another is that the market has a funny habit of pretending controversy erases demand, right up until the next round of numbers forces everyone to look again. So when I step back and look at all 5 of these ideas together, the message is pretty clear. The AI trade is not just about who designs the brain. It's about who builds the room, who powers the room, who cools the room, who stores the data, and who assembles the systems that make the whole thing usable at scale. That is the reset. Not some magical slogan, not some mystical number thrown around to impress people. I'm talking about capital flooding into physical and digital infrastructure at the same time. And when that happens, the winners are often wider than the crowd expects. Now, before anybody gets too carried away, let me add one more thing. A boom can be real and still get over-owned. A cycle can have years left and still punish late entries. Even now, after the rebound, I don't think the right move is to run around buying everything with AI in the sentence. Some names have already sprinted. Some are living off narrative more than execution. Some may need time to digest. So I would rather be selective than euphoric. Watch earnings revisions, watch backlog quality, watch customer concentration, watch margins. Watch whether management keeps matching the promises with actual delivery. Those things matter more than daily price moves. And there's another reason I think this matters now. The next leg of AI spending may look less like a beauty contest and more like an industrial cycle. When that shift happens, investors who only watch the celebrity names can miss the supporting cast doing the heavy lifting. We've seen this in other booms before. The obvious leaders grab the headlines first. Then the suppliers, service firms, and infrastructure providers start putting up numbers that are harder to ignore. That doesn't make them risk-free. It just means the opportunity can spread much wider than the crowd initially assumes. And one more quick thing before I wrap this up. If you're successful, share your success story in the comments so others can stay motivated. Because that's really the game here. Not chasing every candle, not trying to look clever on every dip. It's about understanding where the money is moving, staying honest about the risks, and positioning around the parts of the trend that have real demand underneath them. If this cycle keeps going, I think the quiet winners may stay surprisingly loud for a lot longer than people expect. And if the market wobbles again, don't automatically assume the whole theme is broken. Sometimes the market is just doing market things. Sometimes the crowd gets scared. Sometimes the algorithms get noisy. Sometimes a good company simply has to breathe after running too hard. That said, stay sharp, especially on the controversial stuff. This is for education, for thinking out loud, and for helping you ask better questions before you ever put real money to work. It's not personal financial advice, and it sure as heck isn't a promise that any stock on earth will behave.